All right, so the test is behind us, and I guess spring break's behind you as well. Spring break in Alaska. I don't know what you all do. I always used to go to Mexico. Got a little sketchy towards the end, but this was, believe it or not, I went to school a few years back. So anyway, Mexico was not quite as dodgy as perhaps it is now. Depends where you go, I guess. We're going to talk about the exam. Like I said, I think it was pretty straightforward. If you didn't know what opportunity cost was, that's not going to help. Liquidity, another key term. But again, life is kind of the same way. If you don't know what opportunity cost is or liquidity, you're probably not going to manage things quite as well and probably not be in the situation you want. There's tons of books written, The Wealthy Barber and some other folks who, for one reason or another, had a job. Maybe they liked it, but perhaps it didn't pay that well, or maybe that's the only job they could get anyway. But they still didn't want to sacrifice their financial life, and so they just needed to be smarter with their money. Sometimes, if you make it, there are people out there who make a ton of money, but again, end up living paycheck to paycheck because they're not good with it. But anyway, if you understand what opportunity cost is, if you have a certain amount of income coming in and you realize the trade-offs that you're making by not investing, you'll know how you end up. So anyway, opportunity cost, what you give up, what you forego as a decision. If you're smoking cigarettes every day, I think society's beat you down enough, but also financially, man, if you had that pack of cigarettes in cash and invested it wisely, you could do pretty well. There's other things too, though, that do just the same. Other, not necessarily bad habits, but things that are fairly insidious that you end up pumping a lot of money into that you probably don't need. I don't know how many spare cushion, whatever kind of garbage at Target my ex-wife used to buy, but she wondered why, because we kind of sort of kept our finances a little separate, and all of a sudden I'm buying a Viper, and she's like, where'd you get that money? Well, it wasn't from buying clutter, cushions. Anyway, you can tell how my marriage worked out. Okay, another opportunity cost, giving up a movie in order to study for your finance exam, certainly. Retirement planning, time value of money, If you give your money a chance to work, and especially if you haven't invested, now I'm not just talking about, you go out and get it in an investment that's going to outdo outdo inflation. You need to kind of get off the porch here. You need to realize you're young and you can handle some swings. I mean, I've been super aggressive this past week. I don't want to get political about it, but I'm sure some of you guys would not be excited that I bought Tesla this week. But why did I buy it? Not because I think it's a great company. I mean, maybe it's well run and all, but I think the EV thing, I don't think there's ever going to be the infrastructure to support it and stuff. But the stock is down at half price right now. It's so beat down that I bought Tesla, Nvidia, C Limited, a company I've had. I'm really trying to double up to catch up on that one because it's down from where I bought it. And MicroStrategy. But for example, on the MicroStrategy, I'm up 13% in one day. Granted, easy come, easy go. It's going to be all over the place. But my point is that I can handle some fluctuations because, I'm fairly disciplined on when I'm going to buy and when I'm going to sell. How did that come into retirement planning? My irresponsible, degenerate nature. Don't get confused either. That's what I'm talking about there is borderline investing. That's really more in the speculation, trying to buy the dip and all that kind of stuff. Crypto has taught me some bad habits. Anyway, if spending exceeds the amount of your income over a period of time, that's just not sustainable. That is not a strategy that's going to work. You need to somehow get your spending under control. You can sell some stuff. You can work yourself to death, get a second job, all that, but you need to kind of learn the lessons. Now, if it's a temporary thing, and they're talking here over a period of time. If it's a one-off, don't worry. You have a budget. Maybe you're smart enough to have stuck some money away, but if it's recurring, you got a problem. Liquid asset, cash or cash equivalency. Again, I'm not encouraging you to keep a whole stack of cash because it's just getting degraded by inflation. But I pulled some money out of a brokerage account on, back in, I guess most of the guys are in Boston or whatever. I needed to make a purchase, and it was funny. I had the money by that afternoon. I thought it was at least going to take a couple days. Now, if you're selling stock, there's 2 days settling time. But, again, most emergencies, 2 days is pretty liquid for just about all emergencies. Student loans, housing, what do they all have in common? All those things are over a year, right? What do we know about personal finance and time? Anything over a year is long term. Short term is less than a year. Current liabilities, we're not doing it. This is an accounting class, but that would probably be in short term as well. But anyway, the only one here that would be considered long term is greater than a year, or are all these sort of installment loans too. They don't necessarily need to be installment loans to be long term, but usually they are because they go on a series of years and they're the same amount. Best measure of a person's wealth, net worth. Just because you got a bunch of stuff, if it's all loaned to somebody, you could be quite poor. Now, if it's real estate, maybe you'll suck it up and have a net worth that's kind of low, but you've got a whole bunch of money that's working for you. If you, for example, let's say the real estate market's going up by 3%, but if you're putting 10% down, so that means you're controlling $300,000 with $30,000, or more realistic case, maybe a $500,000 home. So $50,000, you're controlling $500,000. If that property is going up by 3% a year, and you're leveraged, you're using borrowed money to control it all, you're actually pretty smart. You're getting 3% times 500,000, so 15,000. Your equity and your corresponding net worth is going up with that, and you're financing it at less than 3%. I know what you're all are saying. Yeah, those days are gone. Hopefully they'll come back. It'd be very tough to make good money at when we're paying 7% interest, but for some of us, the boomers out there that are holding these loans at 3% or less, they're kind of happy. Anyway, what's important? Why is it important to monitor your debt level? So it does not become so high. So related to that other one about basic budgeting. Money received today is worth more in the future. Yep. That's because you're smart. You understand you're going to invest it. Now, if you're just going to, blow it on whatever, hookers and blow, whatever. You'll still be an idiot in the future, and you're an idiot right now. But let's assume you're investing it. You will do much better. Somebody who's smart. So this gets down. You'll see later in life, people talk about this whole thing about, when should I take Social Security? I actually get more if somebody retires at 67, or they start taking it day one at age 62. All that stuff is when they talk about that, they're looking at a static situation. If you're somebody who's smart and confident in yourself, I would take it at age 62 when I get the chance and start investing it. I think I can do better than my investments would grow. Plus, bad things can always happen. There's 5 years that you're kind of at risk. As you're hopefully floating up to heaven or wherever you're going, damn, I wish I would have taken that money. People tend to die at those ages, so bird in the hand, I would take the money now, but that's just me. Time value of money implies a dollar worth. Okay, so same thing. Yeah, compound interest, you're going to invest that money. Earning interest over time is called compounding. So earn interest on interest. That's the whole key, the seventh wonder of the world. That's what makes your head explode. That as mere humans, we have a tough time realizing just how outstanding that effective compounding can be. Head of household, so now we're jumping into taxes. So, yeah, something happened in your life. You've got children, but you're not married. So, divorce, or you just started out that way. Whatever. The IRS is going to, throw you a bit of a bone here and allow you to take advantage of that situation that you've got somebody who's depending upon you. So, both A and B. So you're single and you have a dependent, right? Now, again, if it is a divorce that caused this situation, that other parent cannot claim this head of household with that same child. Only one person can claim that dependent. Simple math problem. So, buy low, sell high, right? Bought it for 20, selling it for 35. No dividends, so that's easy. Purchasing items on credit will reduce your tax bill. So this could actually need to be rewritten. Trump's talking about making car loans for American-made cars tax deductible. Right now, all this consumer debt is not tax deductible. That's kind of broadly how they characterize everything except for a mortgage. A mortgage is deductible, so it makes a difference. Financial institutions, how do they make money? Yep. They give you squat in terms of interest, and they charge you, a fairly reasonable to a higher rate to borrow the money. Your ability to cover short-term deficiencies is that liquidity again. Whoops, how far did I go? I did skip a bunch. Nope, just one. Okay, disadvantage using credit as a source of liquidity is the cost of finance charges. So, yeah, I was in a situation. I wanted to buy a piece of equipment. I was like $500 short. The guy wanted cash, and so I actually took an advance on a credit card, which you should never ever do. But I only was like $500 short, so it was not a big deal. So, but I paid for it. I did shop around a little bit. They did charge me. I've actually found a stupid American Express card I had that only charged me, I think, 2 or 3% for the advance, and they start charging you interest on it right then. So I pulled the money out on a Friday, and I put it back in there on a Monday. So I only had to pay interest over the weekend. So not something I want to do is pay interest on credit cards, but, for the consideration for the piece of equipment, cool old bulldozer, I needed it. So anyway, stopping payment on a check. There's only certain uses for this. Stopping payment on a check used to be a bigger deal when there used to be this float, when there was a delay in processing checks. Now that checks are processed electronically, meaning that the bank doesn't actually have the check in hand typically, they just have a digital version of it, and so checks clear almost instantaneously. So the check cannot have cleared. Now, if it's a lost check situation, then it makes perfect sense. Arrangement that protects the customer with a debit card, amount of suites. So overdraft, writes a check or a debit card. So again, if you're going to max perform your checking account, it means you're going to not keep a ton of money in there, and accidents may happen, whatever, things get busy. And if you've got overdraft protection, no big deal. It just rolls onto your credit card typically. If you don't have overdraft protection, oh boy, you made a big mistake, and it's going to cost you, fees here and there, and you're not in a position to argue about it because you're essentially a criminal. All the following situations are valid reasons except, everyday living expenses. These other things, sure enough, and some things are smart. Maybe not, this is more bad luck, and college education depends, disciplined use of it to invest in yourself, that's valid. Yeah, get in a car to get to work, that's valid. But, the car you need, not necessarily the car you want. When using credit card, wise to pay off the balance. Yep, so you don't have to pay that interest. Which are the following? So just like I said, they are not treated like other charges. I know pay fees on credit cards because I don't carry a balance, and so I don't care what interest rate they're going to charge because I'm not going to pay it. I'm going to be just a convenience user. But if you take that cash advance, some of these cash advances, I think on the Alaska Airlines card, it was one of the highest. And, it's going to cost me like $50, 10% to get that $500 plus, the interest rate. So I dusted off my credit card collection and I found one that had the lowest fee, and I knew I was only going to do it for a short time. And shoved it in the ATM and spit out the cash just like normal, except it's not normal financially because there were extra charges that showed up on the bill. Which of the following? They are an excellent source of emergency funds for unexpected expenses. Yep. Now, this is only valid if you aren't carrying them. If the credit card's maxed out, it is doing you, worse than no good. It's a negative. You're paying interest on all that money that you got loaned out, and you don't have that reserve in case there's an emergency. So, finance charges, yep, not paid in full, which is different than a cash advance. Cash advance, finance charges start the minute you pull that money out. APR, annual percentage rate, the only number that you can actually use to compare things. Review your credit card statement. Yep, make sure there's no fraudulent charges, duplicates, spending patterns. It's kind of a reverse budget. If you don't do a budget, which I can understand if you've got things kind of under control, but you should at least maybe kind of do like a reverse budget. Go, see where the money was spent. See, how things kind of add up. They're not keeping charge of collateral. Collateral is what the lender has in terms of what they're going to take from you if you don't pay the bill. But it's also, even if they never get anything repossessed, just that the fact that they can pull it back means that the interest rate's going to be lower. Which kind of loan generally charges the lowest interest rate? The secured one, the one with collateral. So it's related to that question. All of the following: cosigner. The lender may not seize the assets of the cosigner. And so this is one of those things, accept. So it's a negative type thing. Yeah, they will seize your stuff. First off, you probably got better stuff than the, friend / deadbeat who borrowed the money from you, because obviously the only reason they're seizing assets is because they left you on the hook for it. They, turned out to be a deadbeat, and now the lender is coming after your stuff. So you shouldn't have done it in the first place, and now that you did, you're going to realize the consequences. Purchasing a home. The real estate commission, which is huge, 6%. So I'm looking at selling a home now. I've got a friend who's going to cut me a deal and all that kind of stuff. But typically it's 6%. 6%. Say again, this $500,000 home. That's freaking. I keep thinking $30,000. Yeah, that's about what it is. Yikes. Disadvantage of a neighborhood with a homeowners association. Association covenants can restrict you. Plus, they got fees. They got this. They got that. I mean, granted, there are no absolutes. You can't say homeowners associations are all bad or they're great, because there's good ones and bad ones, number one, and then in some situations you kind of need it. The best solution, you have a bunch of land and don't deal with neighbors, and they're all your friends because you're not living amongst one another. But if you're going to be in a neighborhood like that, you've got to figure something out. Fixed mortgage, monthly payment. The beauty is it stays consistent. So, if you're barely able to afford a mortgage when you first get into that home, maybe that's not a great place to be, just barely being able to afford it. But the good news is 30 years from now, what seems like a whole lot of money that you're paying on that mortgage isn't going to be much at all. I remember growing up, my parents' mortgage on their home was $133. It's like, yeah. I'm sure it was a bunch of money back when they started that home loan. But anyway, ARM, adjustable rate mortgage. So that's different than a fixed mortgage. Typically, it's really got to be worth it before you want to take that kind of risk. What happens in an adjustable rate mortgage? If the interest rates explode, you're on the hook, and there are limits how fast it can go up, but it can get kind of ugly kind of quick. So anyway, I've done it before. You kind of roll the bones, and if it's considerably, at the time I think it was 2 or 3% less. I was in Europe at the time, and I was just taking a 10-year mortgage, which meant it was going to be a short mortgage, which meant there was less exposure. But I want to say the mortgage was, rates I think up there were about 5 or 6%, and this thing was, I think, down at 2 or something. It was it made it useful. Right now I've looked at the spread between adjustable rate mortgage and fixed mortgage, and it's not good enough. There's not a big enough spread to make it worth it to take that extra risk. We're talking insurance here, ignoring risk, just pretending like nothing bad will ever happen. No, you gotta do something to mitigate it. Avoid it when you can, mitigate it, maybe accept it, or have somebody else accept it. If it's a super low risk, you may just say, okay, I know the risk, it's quite low, I'm going to do it, And it may be something like an earthquake, where you just say, oof, I can't afford, earthquake insurance, or it's not offered. I'm kind of stuck. But I'm not going to pretend like I can just ignore it, like say an earthquake will never happen. No, you should kind of know the odds and at least know the gamble you're taking. Comprehensive coverage, that's kind of the cats and dogs, everything else. So wind, hail, everything else. Deductible, that's, if there's $5,000 worth of damage, you got a $500 deductible. The insurance company is going to pay $4,500, and your $500 is out of pocket. Here's a standard homeowner's policy, and here's somebody that's hit by a flood. Yeah, floods are not covered. That is a different process. Cover the homeowner, you should take out a personal property floater. So this is where you have some jewelry or something like that, so you'll get an additional small policy, a floater, a rider, a addendum, whatever. Just something else delineating the certain items that are above that level. And then best way to reduce your homeowner's insurance is probably to increase that deductible. Health insurance, it's a pretty sad situation, but usually if it's offered by your employer, which most of the time it is, you can generally get it more affordable. So, I think that's it for that. Anyway, life insurance. Okay, so life insurance, again, this is semi-controversial, or at least whatever. There's certain people who will give you life insurance advice, and a lot of popular type things out there from the insurance industry, and in my mind, they maybe have certain conflicts because they're trying to sell you something. The more they sell you, the higher their commission is, and it goes off into the future. For most cases, you need to think about life insurance in terms of what it's going to do for you, why you need life insurance. What happens is, obviously you're dead, so you're not around. It's not for you. It's for the dependents, right? Or perhaps to leave some money for some cause or something like that. But generally, it's to leave money for your heirs. So if you've got a whole slew of kids out there, and you're young in life, and you just bought this new house, it'd be semi-irresponsible not to have insurance, because if you check out, the folks you're leaving behind are going to be in a world of hurt, you know, and they're maybe not, you know, your funeral's not going to be such a nice event. I mean, you can handle a little bit of doom and gloom, but when people are talking about how you're just, you could have taken steps to make the financial aspects normalized. When you're young, in that same situation where you got all these commitments, insurance, life insurance, is typically super cheap, especially if you get term life insurance. Term life insurance is a type of insurance where you just pay for when you need it, a certain term. You know, you get it for 10 years or whatever, and you pay a certain fee. And there is no cash value. If you don't die, it's just lost money. It's not an investment. It doesn't have any residual value, any cash value. You're not going to have it when you're 60, because frankly, you should have saved your money and had your nest egg that would make your life insurance payment, you know, fairly trivial compared to, you know, if you have two options. Say you just turned 30, you already have some kids, you're going to spend maybe $800 a month on, you know, some life insurance policy, or you're going to spend, let's say, $50 a month on a term life insurance policy and $750 a month on investments. The guy with the investments is going to kick butt on the other guy, and he will have that life insurance from day one. Well, life insurance companies, they do invest your money, but the way they're structured, their goals, and all the rest of that, they don't perform to nearly the same level as straight investment companies do. It's just they've got to be much more cautious with their money. And plus, that's just not their expertise. You know, they're more into the sales and this and that. They're not into necessarily maximizing returns. So that's the strategy. When I'm talking about doing the term life insurance and end up in a better financial position, that again shows that you're going to show some discipline. If you've got this $800 that you're going to put towards this whole life insurance policy, if you didn't do that and you bought the term life insurance policy and then used the balance of that money and bought or invested it in good investments, good quality, you know, stocks, whatever, you would be far better ahead. Now, the insurance company, they'll say, "Oh, that's just what I'm saying is false, because people don't have that kind of discipline. They don't save their money. They don't do whatever, and they're just not giving you credit for anything." And maybe if you're, you know, like that, maybe you need, you know, somebody to hold your hand. But it's pretty painful to write that check to those folks every month for $800 and know that it's not going to be put you in the best position later in life. So anyway, psychology, yeah, people don't want to focus on it. Hard paying premiums for a policy you might not need. Yeah, term life, it's not so hard. Believe me, I've gotten these policies before. I've never had a whole life or any of these extended life things, but I've had a ton of term policies. And I actually don't have any policies right now. I don't want them. They'd be expensive. I'm getting a little older, and they make insurance quite expensive. But guess what? My kids are grown, accomplished, you know. Last one's graduating from college this spring. You know, I've got whatever. I don't owe a bunch of, well, other investments. But my investments are worth way more than the amount of money I owe on them. So anyway, I'm in good shape. If I check out, you know, I don't want to make it too attractive to the children, but, you know, if they push me over a cliff, it's kind of scary. There's a bit of a windfall coming their way. So anyway, role of life insurance companies. So yeah, they've got to sell the stuff. Now, do I deal with a bunch of companies? No, not really, because, you know, the stuff I buy doesn't have salesmen, doesn't have commissions. Applying for life insurance, I've had this before. You know, I have mentioned before I was in the military. There's one, I think we were going to fly in Kosovo or something. I don't know what it was. I was flying fighters at the time, and I'd, you know, flown in a few different conflicts before. dropped many a bomb, and this one was just a thing that was coming up. And I was at that situation where I had 2 children. You know, that situation I'm talking about, a new house and the rest of it, and, you know, I'm flying fighters. And so, anyway, I picked up a couple $1 million life insurance term policies just prior to that. And, you know, funny old thing, they're asking if I do, you know, like deep sea diving, and I do recreational scuba stuff, but they weren't too worried about that. You know, wasn't a lumberjack or anything at the time. So, anyway, they didn't see any high risk. They never asked whether, hey, are you, by the way, going off to a war next week? But anyway, so you can get those policies, and I kind of turned them on for a while, and then after I got back, you know, safe and sound, I canceled the policies, and literally they were about $50 a month for $1 million per thing. But they got a little concerned because they've got their central database, and they said, this dude has taken out a lot of policies. He might know something. So they sent some lady who was dressed up like a nurse. I don't know if she actually was, but she came and drew my blood, and she was wearing the goofy little nurse hat and the whole bit. Came out to the house because they wanted to check on what they were actually insuring. So they can do that. So term, super simple. Life insurance that's provided for a specified time does not build cash value, but it's cheap. Premiums on term paid monthly, quarterly, semi, however they want to do it. Determinants. The longer the term, the higher the premium. Yeah, because you're getting older through the course of that. The older the policy, the higher the premium. Yep, you're that much closer to dying. The greater the amount, obviously, linear relationship. Males tend to, you know, die quite a bit more doing stupid things, especially in accidents. Smoker, yep, you should know that. Medical problems, yeah, they'd love to know your medical history and the rest of that. So again, guard that stuff. Anyway, so yeah, it just gets off the chart. You know, annual premium. Here, this guy's paying whatever. That's annual premium, so $500 a month, and down here it's, you know, less than 50. So it's gonna do that. But again, you structure your life so that you're not paying insurance. You know, your kids, whatever. If they didn't go to college, that's on them. You know, when you're this age, unless you're some, you know, guy out there, whatever, hanging out with 20-year-olds when he's 60, but for most of us, we're going to follow this path. We don't have a whole lot of people dependent upon us. Annual premiums, yep, so they're going to go higher because you're older. Yep, that's what I said. Smokers, that's pretty drastic. But I don't think there's that many people who smoke anymore. Decreasing terms, so different ways to do it. You know, they can keep the life insurance the same amount of money and have you pay less, however they want to structure it. That's all marketing. But get the insurance you need. So you know, you look around yourself, you go, well, we just bought a new house, I want the kids to go to college, how much insurance do I need? $1 million sounds about right. And you do it. So if that's an amount, and theoretically, as you pay off on the mortgage, that amount should go down. Mortgage life insurance, they also have this, they call it credit life insurance, pays off your credit cards. What you have here is, it's essentially a little life insurance policy that's built into some home mortgages, and it says that, you know, in the event of your death, your insurance is going to be, or your home mortgage is going to be paid off. And, you know, they portray themselves as being quite magnanimous and just, you know, they're just such good people, they're going to do this for you in this unfortunate situation. Yeah, they're not fooling anybody here. They don't want to be, you know, showing up at the funeral wondering how they're going to get paid. You know, they want you to basically enroll in a little life insurance policy that they've set up through the payment system. It may or may not be apparent to you that you are the one paying that little premium, but it's a little mini life insurance policy that covers their mortgage, covers their interest. And it's all good, you know, but you need to know whether you've got it or not, because when you're doing that calculation of whether you need $1 million when you die, well, if your home's already going to be paid off upon your death, then maybe you don't need that. Group, yeah, just like health insurance, typically cheaper when there's a group involved. Whole life, okay, permanent life. They've got all these, you know, ambiguous names that, whatever. These are something that's much higher premiums, number one, and it also provides a cash value. It's essentially an investment, right? And they're going to argue this is the best because it's going to continue through your whole life. And I'll in the videos here at the end, I'll allow you to look at both sides and you make the call. Just keep in mind that if some friend of yours comes up to you and says, "Oh no, term life is not for you. You need this whole life thing," and goes through the whole, that person may or may not have your best interest at heart. So, if they're getting a commission, it's kind of hard to think straight. So, same factors, limited payment policy, specified over period, but remain for the whole life. So, again, there's not a whole lot of difference between. They'll talk about variable life because that's another type of thing. And what's it mean? It means they can invest in different types of securities, stocks and stuff to try and get a little bit higher, return. But it's still not going to be the same as a regular investment account. Comparison to term, yep, much higher premiums, accumulate savings, premiums remain constant. But again, your need for life insurance as you get, into your 50s and stuff should be decreased greatly. Universal life, period life, variable life. So, but more in different types of investments, and also may have a term portion. These are just going to be more complex products that you're going to have this salesman kind of explain to you, and they're like licensed to do all that stuff. The term stuff, yeah, you don't have to go through all that because it's straightforward. You can figure out term all by yourself. You can buy it on the internet. Determine the amount. So I touched on this a little bit. This is kind of silly, 10 times your annual income. What if you have no kids? What if you're single? You don't even need insurance. So why are you doing this? No, you need to look at where you're at in life. You can make it more complex, annual living expenses, future expenses, children's college, whatever, debt that's out there, maybe the big house. Did your spouse take care of the kids the whole time and perhaps needs to go back to college to, get the type of job that, he or she may need when you're checked out, so why don't we do the annual living expenses times like 3, a couple 300,000 to kind of give a bit of a buffer to your spouse. How much do you have in savings? So anyway, all this stuff should decrease as you get, or the necessity for it, even if, if you're young, you probably want your, remaining whatever. Maybe they'll get remarried, maybe they won't, but, some of that retirement savings that you would have accrued over the years, that's not going to happen now. So, what you're trying to do is you're trying to just normalize the people who are going to be affected by you passing away. The internet's not, it's not a magic thing. These guys seem to think, oh, just go on the internet. Yeah. We used to talk about, it's PFM is what they call it, just pure effing magic, it's just going to spit out an answer. If you don't know where that answer came from, if you don't know what the parameters are, then, just go back to pen and paper and figure it out for yourself. If there is some sort of tool on the internet to help you out, and they can show you what the factors are and what their considerations are, maybe it's useful. So, limitations. Yep. Family income may not rise. Yeah, inflation. Lots of things could happen. So that's why you're kind of going on the safe side. And if it's term life insurance, yeah, go for the $1 million. Why not? Because it's literally $10 more a month or something over the, 800,000 or something. So it's quite affordable. Yeah, different calculators that are out there. Needs and dreams. Yep. But again, you should, make that whole funeral situation an emotional situation, not a financial situation. Now, if you're, a single person and you live life to the extreme, yeah, you want that check to the funeral home to bounce. You want to have spent everything and go, having left nothing behind. Or maybe left it all to a good cause and still bounce the check to the funeral home just out of spite. Whatever. Okay, contents of life insurance policy. The beneficiary, that's that person that's named that's going to get it. Grace period. Sometimes there's a period where this can work different ways. Grace periods can be used. Let's say you miss a few bills. They can't just cancel the life insurance policy on a whim, because you're dead, for example, and they say, oh, he didn't pay that bill. Well, he died. Well, sorry, but he, whatever. So that's what grace periods have to do with. There's also usually an exclusionary period for, say, like if you die within the next 6 months or a year or something, you probably weren't so honest on those, existing conditions that you said, no, I was completely healthy. Living benefits, this is kind of, cool and, the best of a bad situation. Let's say you're terminal and, but the family's got no money. They're going to come into this windfall as soon as you die. Well, why not, break loose with a little bit of that cash now to, give you that end of life trip or maybe that, whatever, something to not have you in poverty up until the end, and then you pass away and then they get a big fat check. Anyway, non-forfeiture clause. So this gets to terminating these whole life policies. If it does have a cash value, yes, you can take a loan against it sometimes. Incontestability clause. Contestability means that, basically arguing over about it. Whatever. If you die 3 years from now and they say, oh, that was an existing condition, it's like, yeah, that's not contestable. It's been too long. If you had questions about my health, you should have fought it back then, and you didn't. Renewability option, sometimes on a term policy, that you can re-up it. Conversion, going from term to whole, they'd be very happy for that. Settlement options, so do you want a lump sum? Do you want a series of payments? If you don't understand all that, you may work with some sort of financial advisor. Just it's not too different than some of these, word problems we've had where you're looking at the future value and should you take the money now, however you want to do it. Whoops. Okay. Lump sum settlement, installment settlement, so those would be the options. It's kind of like winning the lottery, but not nearly as fun. Interest payments, so yeah, this is just a different way of paying that out. And again, it has to do with some of these, not the term policies. Okay, selecting the life insurance. So AM Best, so you're gonna know certain things. You can't be expected to, be a genius on reviewing all investments and all the insurance companies and all these different things, mutual funds, which ones. No, there's usually third-party folks, third-party agencies, companies that, don't have a financial interest in the insurance company themselves. They're not giving themselves J.D. Power awards or, some paid-for award here. These are actually rating agencies that they they trade on their reputation for being objective. And so if you're looking at financial stuff, it's usually Standard & Poor's, maybe Moody's, somebody like that. If you're looking at mutual funds, typically Morningstar, somebody like that. But in the insurance world, AM Best. And what you're doing is you're making sure that this great, rate, you see this term policy from this company you've never heard of, is that sketchy because, that company needs to be solvent. They need to have money to be able to pay your claim. So you don't want to pay a bunch of premiums to a company that financially is upside down. So you would look at their AM Best rating to make sure they're a good company. All righty. So that's kind of life insurance. Like I say, it's an important thing, but beware of the salesmen out there who, especially again, I'm talking about a bunch of military stuff, but they were just these creepy. They'd get old retired officers, colonels, generals, and we'd be a brand new lieutenant, and they'd take you out to dinner, and they do this and they do that, and they give you this fatherly advice, and they were horrible fathers. They were making money. They were trying to sell you stuff that you didn't need. So that's kind of why I developed such a negative reputation towards that. Okay, investing fundamentals. So buy low, sell high, basically. And it's a lot more complex. You got a lot more options. It's kind of fun because, especially of the younger generations and the emergence of crypto, there's such a sense of desperation in this. You only live once kind of stuff. The boomers, they don't take that kind of risk. They're used to having a retirement plan that's going to pay, and they're going to be taken care of in life, and it's not all on them. And then there's other people that are incredibly risk adverse. So you need to be a little smarter with this stuff and get involved. And for me personally, I'll watch some sports like, mainly college stuff, like college football or whatever, not so much into the pros. I absolutely don't watch any pro basketball or any of that kind of stuff. That sort of outlet for me is more watching stocks and crypto. That's where that part of my personality that would normally be watching sports teams, knowing numbers and stuff. I probably know more about the performance of NVIDIA versus whoever's in the Super Bowl. So anyway, if you do find that that's kind of enjoyable to you, that could kind of serve you well, because maybe you'll make some good disciplined bets in life and do well. Now, again, I've talked about investments versus speculation. You need to be investing with the majority of your money. It's fun to speculate a little bit, but we're talking 10%. Don't be doing these whole, YOLO moves on things. Don't be using leverage in crypto. You are not investing. You are speculating, and it'll catch up with you. Now, it's all fun to get 10% of your money. Let's say you've got your discipline plan, and you're paying yourself first, and you chose 10 or 15% of your income, and then, oh, by God, at the end of the month, you got a little bit extra, and you're going to blow it on some stupid stuff at the track, or, God forbid, a casino where, you all you have to do is walk in the casino and you realize who built that, who paid for that. So if you're going to have that degenerate behavior, perhaps some speculative stocks or crypto would be the thing for you. But again, the majority of your money, your retirement money, all that stuff should be in investments, not speculation. So, personal balance sheet. First thing you got to do is you can't have credit card debt. If you've got credit card debt, if you think you would have to be a phenomenal investor to outperform the amount of interest you're paying on your credit card debt. Okay, the stock market, it can return pretty solidly, 10%, with not a tremendous amount of risk. There'll be up years and down years, but if you're disciplined, 10% is definitely doable. Credit card debt is going to be twice that, 2.5 times. So yeah, you're making 10% with the money, and you're spending, 20-some% on interest. So you got to have a clean, paid off credit card. And yeah, don't spend yourself into, some liquidity is good. And also having money on the side. I tell you what, I don't want to go into exact numbers, but I had a pretty good chunk of cash on the side, and I saw the market tubing this last week, and I knew that, whatever, just the way things were going to work, that they were probably going to settle on the budget. The market may go down a little bit more, but I think it's already turned the corner, is going up. So having a little extra cash and being able to jump in that was fortuitous. Money market securities. These are securities that are basically government securities. So not a lot of risk, full faith and credit of the federal government for government securities. But, better than a regular old, savings account or something like that. Stocks. So stocks represent an ownership position in a company, right? If you have some money and you put it in a bond is a loan to a company, or it can be a municipality or, a federal type thing or something like that. But a bond does not represent an ownership or an equity position. Having stock represents an ownership position. So if that company goes out of business, you can't say, hey, I need my money back, because the fact is that company that went out of business was your company. You had a portion of that company. Now, if it goes out of business and you had a bond on it, number one, that bond shouldn't have been very highly rated. You should have seen this coming. But, there's a chance you might be able to get a little bit of that money back. But good luck. Good luck with that. The company wouldn't have failed if they had money to pay out. So I don't typically buy bonds at all. They're going to make a big deal here out of common stock versus preferred stock. The reason I don't care about that is because I don't get involved in what they call income stocks, or stocks that are mature, that are paying a dividend. If a company's not paying a dividend, it's not a big deal. So, quick thing on dividends and that kind of stuff. You have different companies, right? You have big companies that are mature, they built everything, and now when they have a profit, they're returning that profit to the shareholders by way of a dividend. Younger companies, they're growing. If they have any profits, they're pumping it back into the company. They're trying to make that company grow. So they're not paying a dividend. They're getting all the profits, and they're a growth company. They're trying to, do that. So if you have an income stock, you're hoping the stock price goes up a little bit, but you're mainly living off that dividend that's paid to you. If it's a growth company, there is no dividend, and you're making money by buying the stock at a lower price and selling it higher when it grows. And so I've always been in the the high tech, the aggressive, the growth kind of stuff, and normally that's probably too aggressive a profile. But like I say, I like real estate, so I get all my stability, all my that sort of calm part of my investment portfolio in real estate, and everything I got in the stock market is fairly aggressive. So overall, my risk exposure is kind of moderate, but my stock portfolio is like super aggressive, but it takes more time. Primary versus secondary stock market. So what happens is you can buy stock directly from a company, and that's the primary market. Like you're going to buy shares in Amazon, or I used to work for a company called Booz Allen Hamilton, just a soul crushing, just faceless. Not there's a reason I don't work for them anymore. Anyway, but those guys, they would sell employee stock purchase program, and they would sell me stock at a lower rate. They would give me a 5% discount on it. So I would buy all that they'd sell me. Now they limited it to like, I think, 5% of my salary or whatever it was. But I'd buy that much every time it was offered, and I'd sell it the next day. They never tracked the sales, but they would go, wow, this guy's just completely taking advantage of us. He has no faith in the company. I wanted to diversify. I'm already working for the company, and now if I have all my investments in that company, that's not a good idea. So anyway, I would, I think the shares are going for maybe $100, and I'd buy them for 95 and I'd sell them for $100. So I just looked at it as a little surplus to my income. I think I made, I don't know, $700-800 a year doing that. I mean, it was a couple keystrokes at zero time, zero effort. But anyway, that's where I was buying it directly from Booz Allen Hamilton. So that was the primary market. Now, if you're going to go down, let's say you're going to buy Apple stock, Amazon stock, whatever, you're buying that in the secondary market. You're not buying original shares. You're buying, shares that are already out there in the market. You go to a brokerage, and it's not like it's a used car. I mean, they don't work like that. They're the same quality as the other ones, but unless it's like an IPO, initial public offering, or you work for the company, or you do some cumbersome, stock purchase thing directly from the company, typically you're just buying secondary market type stocks. So anyway, so why am I talking about the stock market so much? 10%. 10% is literally what the stock market has returned, over a century. So it can happen. Now, the ups and downs, this is where the discipline comes in. If you're a horrible investor, meaning that you lack discipline, and if you sell at the wrong time, you're not going to make 10%. If they say there's a market crash, I don't participate. I don't sell that day. There's only 2 days that matter to me. The day I buy, the day I sell. Everything else is static. It's just noise. You don't put yourself, have your liquidity set where you don't need the access to cash that badly, and don't get forced into sell decisions. And don't, and I'm not advocating day trading or any of that kind of stuff. Most people lose in that sort of thing. But if you discipline buy into an investment, you have control over selling. You don't panic and sell at the bottom. You'll do just fine. So it sounds like I'm a big proponent of market timing, and in reality, with speculative stuff, I do. But for the most part, what I did throughout my life, and what most of you will do through your life, is what we call dollar cost averaging. It means you put in, your DCA and dollar cost averaging. You put in, say, 100 or 500 or whatever dollars a month into your investment type thing. And you'll generally be buying mutual funds. So again, I'm talking about individual stocks. Mutual funds are probably a better bet in just about all cases, because what you're doing there is you're buying a variety of stocks. We'll talk more about mutual funds now, but if you understand stocks, you can understand mutual funds quite easily. But anyway, let's get back to my thing where you're buying the stocks and you're buying, your set dollar amount each month. If the stock price is in the toilet, it's way down, there's a crash, you're buying a bunch of shares that month. And let's say the next month, the stock market's booming, which is great if you're selling, but if you're buying, they're kind of expensive right now. And since you're DCAing, since you're buying the same dollar amount, well, you're buying a little less that month. So you're strategizing, you're investing. You're not just throwing money around. You're taking a very easy and cautious approach. Plus, it's very easy to do. You set up your investments where your money's deducted from your check, and it's just kind of on autopilot. And then you turn it around in about 10 years and like, holy crap, I've got a ton of money. and that's how it should work. You know, that you don't have to spend every day worrying about this, or maybe you just, you know, you got other priorities in life. Maybe you are the one who would rather watch regular sports, or, you know, God forbid, play with your kids or do something like that rather than look at, you know, crypto or stocks all day. And, you know, you're probably a better person. So do that, and just buy mutual funds. But the key is to buy them, to set that percentage at a comfortable yet as high as you can manage kind of rate, to get that, and let the time value of money and the compounding of interest and all the rest of that for you. Okay, so types of investors. Institutional, these are the big boys. You know, these are the guys who are buying for maybe the pension funds. You know, maybe they're the permanent fund dividend guys here in Alaska. Maybe they're teachers unions, pension funds, all kinds of different stuff. Then you have mutual funds. Mutual funds are run by portfolio managers, right? They have all these selections of stocks that they're putting together into a mutual fund. So they've got a portfolio that they're managing. And then you've got individual investors. And commonly these guys are, you know, some of these are the big heavy hitters, and then other guys are just the schlubs like you and me, you know, that they call them retail investors, guys who are just, you know, doing some individual investing. Day traders, I don't even like this sentence at all. Investors who buy and sell. These guys aren't investing, they are speculating. So we're not even going to go there with day traders. I've had a number of friends who they think they're the best day trader ever on an up market. You know, in a bull market, it's easy to be a great day trader. And then when the market turns bullish, meaning it's going down, yeah, all of a sudden they lose it all. So, yeah, we're talking about disciplined investing, and day trading and investing are not synonymous. All right, bonds, I hit on that, right? Just think of that as a loan. You know, if a company, like I say, the role of banks, you know, when a company wants to expand, they don't go to a bank and get a loan generally. Maybe the big commercial bank will organize some sort of bond offering, but they're not going in there and, you know, borrowing small or even large amounts of money. No, they're usually doing a bond type thing. And there'd be different strategies that get into corporate finance that are kind of above this thing, but it's just not something I've ever found fortuitous in terms of making money with bonds. And then mutual funds, which we'll talk more about later, but mutual funds are a great type of investment, more of an autopilot, you know, cruise control type of investment. You can do super well. You can, you know, you spend a weekend or afternoon doing a bunch of research, and then come back and check on it in a year or two. You know, you're not like jumping in and out. That's up to that portfolio manager. All righty, publicly traded indexes. Because some of these people who are portfolio managers buying and selling and doing all this stuff, they're doing a lot of churning. They're creating a lot of fees, and you know, they're taking a lot of money for their services. And in a bull market, sometimes the market itself is just going up, and so you just buy across an index. You just buy a little bit of the whole market, and you just call it good. And so it's a super low expense ratio. And sometimes those guys, because they have such low expenses, you know, you want to get the maximum amount of money at the end of the year, right? And so if one person, you know, gets 15% on the market in an index fund, and the other person, you know, the fund gets 18%, but the person who managed the portfolio, they've got expenses that equate to 5 or 6%, you know, even though that portfolio manager did this great job and got a higher return, you didn't get to keep all that return because the expenses ate it up. So they go in and out of favor. There'll be a homework kind of assignment on this. It's getting a little dated now, but you know, people have bet forever on index funds versus managed funds. And then real estate. You gotta love real estate. Real estate, all these other investments where I talked about buying stocks, you can buy those things on margins, but it's a whole different game, and that is not investing. That's speculation, right? Real estate, though, you can use borrowed money, and you're still, I think anybody would consider that still investing, because real estate is stable enough to where the values, my land will not go out of business. The value will never go to zero. Things like that don't happen in real estate, normal real estate. But, so using borrowed money and using that leverage and using that example I was giving you before where you use, a small amount of money to control a big asset, an appreciating asset, can be quite fortuitous. So, returns through stocks, I had to kind of talk about this already just to, differentiate why, what dividends were. So, income stock, yeah. Well, you can make money in stocks with either dividends or price appreciation. So, price appreciation, the capital gain, the just profit from the price of the stock going up. So, growth stocks, yep, those guys are growing, not paying dividends. Income stocks, usually big, large companies, and they're paying dividends because, they've built out their buildings, and their stock price is not expected to do anything, great. So the only way they're able to keep investors, not have everybody go to the growth stocks, is by paying them a dividend. Some people are whatever. I'm agnostic. I want the one that's going to make me more money. And, generally I've found that growth stocks will do it. Growth stocks are riskier, certainly. Income stocks are, more for the people who are living off that income. Maybe it's, somebody who doesn't have a different type of retirement and they're going to live off their retirement. To do it off growth stocks, that's kind of a gut check. To do it on income stocks with dividends, it's fairly predictable. Investing in bonds. So the way you do a bond is, let's say you get a 20-year bond for $20,000. The deal is you give them $20,000 and they start giving you, a payment on that bond. So they give you, say, whatever, $500 a year from now until 20 years from now. At which point they give you all your money back, that 20 grand, and then obviously you got to keep all those payments. So, kind of cool. But you're tying up the money for a long, long time. You can't invest in other things. So, we'll talk more about bonds later on. Mutual funds, exactly. Mutual funds are just stocks, but you're more diversified. You've got, you're not betting on NVIDIA specifically. If you were pressuring, if you knew NVIDIA was a great company, you had some special experience, maybe that's the best way to go. But most of the time, you don't have that kind of foresight, that kind of luck. If you would have just invested across the whole, semiconductor industry, you wouldn't have had to been so specific. Real estate, you're going to make it on, well, if it's income property, rental income, but if it's raw land, just price appreciation. We know how to work this out. I mean, we can do this in our head. All these P's and T's and stuff are just going to kind of confuse you. The price you paid for it, the price you sold it for, how long did you have it? Easy enough. We're not going to make it harder than it needs to be. And if there was a dividend to be paid, certainly, you bought it for this price, you sold it for that price, but you got, $5 a year or $20 a year or $50 a year, whatever the dividend. You would add that on to the amount you earned. Different tax rates. So, interest payments, ordinary income, capital gains. Again, this 1 year thing, long-term, short-term. Short-term capital gains, they're taxed as ordinary income. So if you're in a 28% tax bracket, you're paying 28% interest on that. If you can hold it for over a year, then you're going to pay about 15%. So it's generally about half the rate if you can keep it over a year. So again, if you're speculating, if you're jumping in and out, you're going to be paying a higher tax rate. If you buy and hold anything greater than a year, you're going to pay a considerably lower tax rate. Yeah. So there's more to this, though. I mean, if it's a speculative stock and the price is way up, and you hold it for a year, but the price, it was, I don't know. You got to know what you're doing. Most cases, though, keep it more than a year. All things being equal. Investment risk. So, risk is not a bad thing. The only reason you're getting a high return is because you're experiencing some risk. What is bad is unrecognized risk. If you are getting a crappy return, yet you're subjecting yourself to a tremendous amount of risk, then that is not good. They should be correlated. So bonds can be rated. Bonds, stocks, there can be recommendations. Again, there's subscription services. There's other things out there, but you really have to check on their track record. I used to use a subscription service that was pretty darn good, and then their luck kind of soured, and now they've just destroyed a few people's wealth. The bond rating agencies, they're just rating the strength of the companies, whether that company's really going to be around when it's time to give you your money back. Return risk, yep. So small firms, growth, yep. IPOs are difficult. IPOs, the problem with that's an initial public offering. It's like when a company's going to go public. Let's say Facebook, when they went public a few years ago. I don't know whether they went as Facebook or Meta, but anyway, they decide about how much they think their company's worth, and they put it out there. And maybe they guess right or wrong. The market ultimately decides what the stock is worth by the end of that first day. But the other problem with IPOs that it's not a democracy. It doesn't mean that they have to offer everybody the shares on the first day. No, for most people, if you're trying to buy an IPO, you're probably going to be buying secondary shares, meaning that somebody already bought them, speculated, and now you're buying them like 2 hours later. They offer this stuff, to their best clients, and meaning, super wealthy, insider, borderline corruption kind of stuff. I don't do IPOs for the most part, but whatever. IPOs are definitely in the speculation risk. And then bonds, yeah, high risk bonds. So if somebody's trying to sell you something, they'll say, oh, it's a high yield or high risk bond. They probably won't even use the word risk. They'll say high yield. The reason why they're paying that high yield is because they have to, because nobody's going to buy it if they offer a normal rate, because you are exposing yourself to a lot of risk. So, a high yield bond and a junk bond are the same thing. It's just depends on the person trying to sell it to you. And mutual funds, they can be comprised of anything. Now, there is a intrinsic benefit that they are typically more diversified, but if they're filled with a bunch of garbage companies, yeah, it's a garbage fund. So you need to look at the underlying assets, which is easy to do, and I'll show you how to do that. Risk return, renters, yeah, if it is income property. Property value could decline. Can. Back in 2007, 2008, values actually went down a little bit, but for the most part, real estate will kind of flatten. It typically, I'm not talking about, Las Vegas or Phoenix or Miami. There's some markets that are just crazy, but a normal market, places where it's family homes, not nearly that volatile. And then making decisions, yeah, borrowing to invest, yeah, using margins. Taking risks to recover losses, yeah, you've already lost a bunch of money and now you're going to get riskier to try and double up. And then the term project. So we got the final behind us, or not the final, the midterm. And so, again, I've actually had a student send me a paper. I apologize that I haven't got to it yet, but I'm going to review that student's paper, and if they, if it looks good, they'll get an A right then. If not, I'll tell them what needs to be done to get the A they need. But this project is to kind of put everything together. Look at what are you going to do in terms of insurance? What are you going to do in terms of, investing your money? What's your retirement path forecast to be given your chosen profession? It's a lot more difficult than it used to be. Used to be, I work for a good company and they'll just take their pension plan. Not so much anymore. A lot more of it's upon you. Most companies have what they call a cafeteria plan, meaning that, you pick and choose the investments, the health care. It's all on you. Makes a lot more to it. So now I know most of you are going, but I don't know what I'm going to do. I have no clue. I'm just, I'm taking this major, but whatever. You just make some estimated guesses. This is what I plan to do. This is where I plan to work. And again, I don't need your personal detail in depth because, number one, you probably don't have it since you're kind of guessing what you're going to be doing. But the other thing is, just a forecast of a scenario for, somebody that's close to your situation. So, anyway, the goal is to come up with a plan. And then as you go through life, you modify that plan. But at least you've thought about it. And that's about it. I don't know how long this one went. Let's see. Yeah, 1 hour 15. Too long. Anyway, we'll talk more about this stuff next week.